What's going on, guys? Welcome back to the channel. We have some breaking news coming out of China here tonight again, and this is really something. So I don't want to waste any time. Let's get straight into this video. Hit that like button for me, consider subscribing to the channel, and let me know down below in the comment section if this makes sense, because we're going to kind of talk about the macro sense of why this is so significant and why I am bringing you guys these late videos when I typically don't. So let's dive straight into it. But before we do, let's talk about this first. From the Financial Times, hedge fund managers fear the painful losses they suffered in the meme stock trading frenzy of January 2021 will be repeated if the US regulators press ahead with reforms to securities lending, one of the most opaque practices in financial markets. And this is coming from Financial Times. So this is kind of crazy that they are coming out and saying this statement on top of the article that we have already went over about the hedge funds that oppose SEC's reform plans for GameStop debacle. Kind of interesting. Maybe they're trying to send us some signs that we are fighting the good old fight and that we are on the winning side. Regardless of that, the actual breaking news: China's central bank cuts key lending rates, including one for the first time in nearly 2 years. So the thing about China is they have a lot of different kinds of rates. We went over about 2 days ago, and this was also very late because right now when you're watching this video, likely if you're watching this tonight, then it's daytime in China, so we're on the opposite sides of the world. That's why you get these late videos. But they cut the MLF rate, that is the 10-year rate, and that's a big deal. Now they're cutting it again, and this has a dual implication, and we're going to go over that in just 1 second after we get into the key points. And this is where the macro sense of all of this hopefully will make sense to you guys, because when you're thinking about the AMC trade, if you're thinking about just AMC, that's the micro, what AMC is doing on a daily basis, on a yearly basis. That's the micro trade. The macro trade is the whole entire world, can be the United States, looking at the broader picture, and that's more important than focusing on the micro, like the technical analysis, the option chain. It's much more vital to focus on the macro in the longer sense of this trade, because we know liquidity needs to be restricted. As far as the key points, China's central bank cuts the 1-year loan prime rate by 10 basis points to 3.8% to 3.7%. The 5-year loan prime rate was reduced by 5 basis points from 4.65% to 4.6%. The first cut since April 2020 at the height of the coronavirus pandemic in the country. So there's two things to really point out here. One that could be seen as positive, one that is definitely in the bearish direction. So when China raises or cuts interest rates, they do this in many different intervals. It's much different than the United States even doing a 0.25% rate hike, because that's how they're going to be doing this, is 0.25% rate hikes over and over and over again, all the way to likely 3% again. China tends to do smaller rate hikes but more frequent, so it's not a big blow, it's a lot of smaller blows. But this could be seen as a positive, and the Chinese markets are actually up based off of this, because money becomes a little bit cheaper to get a hold of, to borrow from. And that's the positive. That's really the only positive. The negative here is that this is sending the world a message that China is not in a good financial situation. You have the United States that has too much money out there, that is cutting rates or about to cut rates, definitely by not buying as many bonds, making the 10-year treasury yield go up, which is raising your real interest rates. But China is cutting their rates. So obviously different situations that are going on, but China and America, the number one and the number two players in the world, are very important. And what likely happens in China happens in America, and vice versa. So I think this is just a sign, and it should be and will be a sign for investors, that the Chinese economy is slowing down. So the American economy is likely to start slowing down as well. And I think it could be seen as a pretty bad thing. The more that they start to do these slashing rates, it's not going to be good. However, you see the cookie crumbling per se. So that's gonna be all for this video. My daughter is having a ball over there, so apologize for her. You guys already know the deal on that. Hit the like button for me, consider subscribing to the channel. Let me know down below in the comment section if this makes sense. If not, I will give you guys a full-on macro lesson about how all of these things are interchanged and all point to different things. But ultimately, this is pointing towards the Chinese economy is slowing down and not great things are ahead. You could see short-term gains like we're seeing in the Chinese stock market that are very short-lived, but ultimately result into a very bad market. So that's going to be all. Love and appreciate you guys. Thank you for watching. I will see you in the next one.